Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to UK investor and stock picker Richard Crowe, alias Cockney Rebel. So welcome, Richard.
I've got two lots of sound coming through at the moment, Paul. So
yeah, I did wonder where that echo was arriving from.
Two lots of sound coming through at the moment, Paul. So
yeah, I did wonder where that echo was arriving from.
Two lots of sound coming through at the moment, Paul. So
yeah, I did wonder where that echo was arriving from.
I'm not logged in anywhere. Hold on, let me just make sure. Got rid of it.
Oh, okay. Well done. Okay, well, let's start again. Okay, so apologies for everyone. So anyway, Richard's a UK investor and stock picker. So, welcome and, great to speak to you.
Yeah, and you again, Paul. Yeah, it's been great at the moment. So nice, sunny weather, sunny markets, sunny everything. So can't complain at all.
I don't want to put any gloom on it, but we've had obviously a lot of volatility over the last 2 or 3 months. Not least the sort of like the Trump trade tariffs, the Israel-Iran conflict, Russia, Ukraine, and the UK spending review last week. So putting all that together, what's your sort of like outlook for equities going forward?
Well, I think it looks really good at the moment. I think post the Trump tariff plummet, and sort of since that's happened, I think everybody has suddenly thought, well, that's a buying opportunity at this low, and everybody's steamed back in again. And unfortunately, we sold out on just ahead of his tariff fall, so that was I dodged a 20% fall there. Well, probably 18% of it or whatever. So I was pretty much all in cash right as the market bottomed, and I bought all back in straight on. Doesn't always work that well, but I did tell everyone I was doing it before I did it, so it's not an after the event, I'm so clever thing. It was just I could see it coming. I follow the FTSE World Index, which is the AW01 index, and that showed the big rolling top on that. So I was scared about that at the time. And as soon as I saw that starting to break down, I thought, you know what, I've ignored this too many times, and this is a time not to ignore it. And fortunately, I was out when he created all these mad, his chart with everybody. It was like watching Eurovision Song Contest and nil point, 15% tariffs for this one and this one. And so having got over that, I think the market's got over it. And it's just every day's a school day with Trump in it. You learn something new every time he says something. So in the market. So yeah, but I think since then people have realised that the best place to be is the stock market, and small caps have been doing great. I sort of said about 5 or 6 weeks ago that I thought small caps had bottomed in on my Substack, and it's gone the way I thought. And I think a lot of these funds that have been out in the US and shot off to there to try and make money because they couldn't make money in the UK, I suddenly thought, oh blimey, we've got too much money in the US and shares are falling in the US, and the dollar's working against us as well, and we've made a mistake here. Well, as you know, with Argentex, that was sort of overconfidence in these funds, and they're abroad, and it's this is easy, you make money easily this way, it's nothing like it. And suddenly it comes back to bite you. So now I think they're all trying to buy their way back in the market and driving small caps up where they want to buy, and mid caps, to get back into the UK. So I think that's where we're doing okay.
Yeah. What's that indicator sort of like saying at the moment? Because we're heading into that 8th of July date when the 3-month standstill sort of like agreement that Trump had put together with the tariffs at 10% before he then chucks them up. And so what's that indicator, and what's your thoughts going into that major potential event on the 8th of July?
Well, the FTSE World Index, that made a great big rolling top, and then it just made one great big sharp dive of about 20%. Yeah. And since then it's recovered straight away back up again and made a new recent high just recently. So although you could say the rolling top could carry on still on that basis, it's only just got above its previous high. It looks confident, the way that has bounced back. And when you see these bounce backs, it always surprises me how fast the S&P makes a new high. That drop of 20% on that index was so fast that people who sat on the sidelines trying to buy, they've all bought their way back in again, and you get to the point where you start then feeling you're missing out. As the S&P starts to get near a new high, and if it breaks into a new high, suddenly everybody thinks, oh, we're missing out again. So it's that whipsaw effect for a lot of investors. A lot of investors, you've got to be on the right side of when these markets move, and everybody's going out at the bottom, and they're all buying too much at the top, and you're on that whipsaw that you can't, you can't sit yourself the other way, so you're buying on the lows and selling on the highs.
Yeah. Well, stay tuned to Richard's weekly Substack, because if that starts to fall over again heading into the 8th, I'll be reading it anyway to get that alert. So at the moment, then, what sort of percentage cash do you hold? If you were sort of like 80% in cash before that fall, and then you bought back in, where are you now? And also overall, then, so what's sort of been your returns at this year to date, or over the last 12 months? It must be very good. My cash
is about 5% now. I'm nearly fully invested,
yeah.
And I think since that Trump fall, I think I'm up about 35%. Where it's bounced back about 20, I'm up about 35. But I've had a couple of good ones like Filtronic, and the works has doubled. Filtronic has doubled. I think Staffline's up 50, 60%. And I went heavily into small caps. Right at that point when the market bottomed with Trump, that was my move from mid caps to small caps. So I've got rid of a lot of the big mid caps. I've still got some Marks and Spencers, but I've got rid of all the Rolls Royce. A few Marks and Spencers. I'm trying to think in the mid cap range. Yeah. Looking at them, Dunelm. I've got some Dunelm still, and I bought Prudential as well because that's going up in a bit of a bowl. So there's a few bits there, but mainly the small caps have really been sort of like they've done me proud since that bounce. Carclo's back in near a new high, and I think Kier Group, that's another one that's having a cracking time hitting new highs. So lots of them are hitting new highs. So
brilliant.
It's a matter of following trends, making sure you follow trends, and you're getting charts that are on the direction up, and getting rid of these ones that are rolling over. And there's, it gives you momentum momentum in your holdings.
Yeah. Good. Okay, well, let's move to one of your stocks. We've got James. He's asking about Filtronic, which you just talked about as being an absolute moonshot. It sort of specializes in sort of like a communication equipment that goes into defense and satellite technology. Biggest customer is SpaceX, which also owns about 10% of it now. And they won an enormous order about 2 weeks ago, about $32 million to increase their FY26 expectations. How do you see this one? And are you going to continue to hold them? I mean, the trend is very strong, but at some point, even the sort of the highest flyer sort of has to take some profits, I guess.
I've been buying more since the Trump fall, and since the spat between Trump and Musk. And the shares dived about 15-20%. Yeah. And I thought to myself, do you know what? This spat between Trump and Musk, they both need each other. It's a symbiotic relationship. Musk has put up so much money for Trump, and Trump is the president of the United States, and SpaceX needs him, and Trump needs SpaceX, and they need people that are going to be, their technology leaders, and he owes Musk one as much as he's a bit annoyed about what Musk said. And Musk has apologised online for a few of the things he said. So it's all. I'm sure that's all going to settle down like everything else settles down. There's a big load of noise with Trump, and then afterwards it all sort of like goes down with Ukraine, and we're in it with Israel now, and the tariffs are they're going to be 50% tariffs, and suddenly we'll hold off for 3 months and all this jazz. So I bought more on the dip when that happened. And Filtronic is a great company. They're a world leader in wave and RF communication. So all these satellites, that boosts the speed at which things move and reduces the latency. So their satellites produce broadband speeds at 3 times as fast as what you're going to get through BT high speed, broadband. And so, sorry.
Mid price 122.5.
You're having some good fun and games, aren't you?
Yeah. So what on that instance, they've got a world lead. They are the company in the world that leads on this, and there's not much competition either. This was old technology years ago for the mobile phones, and what's happened is it's come around again and been used in a different way, and it can be used for sending signals really fast on this low frequency RF minimum wave that they use. The guy that was running the company up until about a year ago was like the global, super brain on RF technology, and it's been used since the technology has been used since the 70s. I think the Russians bugged one of the US congressman or something with one of these RF devices in a little bugging device in a present they gave him. So, but they just remind me now. They're just starting to remind me now of ARM Holdings. We had ARM Holdings had the core for the chips, and they got bought out eventually by who was it? What were they called? SoftBank.
Yeah.
And that was just fantastic UK technology that's just been bought out and gone. And I want to look around now for a listed company that's got that sort of niche market where they're the only company that does such a thing. I look now and I think, well, Filtronic is one of those, and maybe just, I don't know that they'd be an ARM Holdings, but they're in that sort of niche where they're needed, and SpaceX doesn't go out to other companies for product either. It's all vertically integrated, most of it, but they've had to go out to Filtronic, and having taken 10%, I'm sat there thinking they've increased their supply. They've doubled their factory, their new automated factory, which gives them double the supply. But if they started getting supply constraints, would Musk want to move in and make sure that he bought the company and he'd got the supply that, maybe the European satellite companies would like? So there's that potential bid there from Musk as well. But it's just great business, and I think if it's been moving lately as if there's some news coming from somewhere.
Yeah, no, you're right. Yeah.
Trading update, I think their next trading update is about the 20th of June, so we're only a few days away. Yeah, that was their trading update last year, so I'm expecting the trading up. People might just be getting excited ahead of a trading update and all got themselves overexcited. But some volume went through there a couple of weeks ago. So a big bunch of 100,000 size trades. Yeah. So
what portion of your portfolio is Filtronic now, percentage wise?
I've got
just roughly.
Yeah, probably about 12-13%.
Yeah, okay. And what time do you sort of trim it?
I don't know. Like when I did sell out, when Trump thing, I sold them. I sold everything, all things I believed in, because I just thought the market was going to fall. And I bought back in. I've bought back in what I had and more. And I don't know. I've just got to sort of. Sometimes you've got to sit in there and you've got to say to yourself, "This is one of those stocks you may give but it's one of those stocks where you could possibly 5, 6, 7 bag over the course of time." And then there's that kick yourself moment, when you look back and you say, I've still got Filtronic, but I've only got 10,000 of them now, and I had X amount. Look back and you think, why didn't I hold? And I've done that so many times. Have I got it this time to sit there and hold? And so I'm going to try to. I'm going to try and sit and hold until I get spooked that much that I decide to take some profits. But see how it gets carried away. That's one of those. You don't see many of these. Yeah. And the valuation still isn't daft, really. I can sort of see if they can they're doing sort of 6 or 7 pence EPS this year. If they could do something like that, or 5 or 6, what it is this year, and next year's forecast just look ridiculous because sales are going to double, and EPS their forecast to half. Yeah, I just don't see how that's going to happen. It looks like I don't know what the reason for it is, but perhaps at this trading update they'll update their earnings go forward. If they, from this year's 5 or 6 pence, if they're doing 9 pence coming year, or maybe possibly more, I don't know. There's that chance that you sort of think these sort of things rated on P's of 20, 30, 40 when, I think just because they've only got SpaceX as a major customer, the rating maybe isn't as high as it could be. But now they're starting to pick up other Leonardo and the other ones out there that they're doing the aerospace, Airbus. Their other clients. Now they're getting more European clients as well, and globally. Then the risk is spread, and so the PE ratio could rise. So
good. Okay, well let's move sectors. Let's go to another one you've mentioned. We've got Kier, which is in sort of like construction and civil contracting. I think they're benefiting from AMP8, the water infrastructure, also for the electrification, putting in sort of like all the EVs and stuff like this in terms of being able to connect offshore wind into the grid. Also, specialist construction, big, obviously spending bill last week in terms of rail and social housing, which they should benefit. And Costain's also, one of its competitors, came out with a good solid trading update this morning, I think, or yesterday. So, what's your sort of view on Kier now?
They've got a lot of HS2 around here as well, Buckinghamshire and all that way. The HS2, they're doing a lot of the HS2 for that. And Morgan Sindall today, they come out with trading update saying that was significantly ahead.
Yeah.
To add to Costain. So they're all that sort of sector, really, the construction sector, and Labour look like they just want to spend everybody's money for the next 10 years on construction and hopefully trigger some growth in the economy. And a lot of it's been the talk at the moment, but these contracts are going to start running out. I did hear that they've got another contract, 50 or 60 million pound contract yesterday. I can't remember.
Yeah, sizable season of the one, isn't it? It's going to be massive.
Yeah. They've got a lot. They've got so much. And the guy who runs it, Andrew Carclo, I think his name is, the CEO, isn't it? And he's full of confidence. And they've got the debt. They've dropped their debt from which was like 400 million down to their net debt down from 400 million to next to flat. They'll be. This year. So it's been one of those turnaround companies that fantastic bowl. I bought them 60, 70 pence. They've doubled, over that course of time. And the chart is just starting to make new highs, and it's constant new highs, and I've just said they're going to increase their margins. I think they said from 4 to 4.5% to 4 to 4.5%. So if you're growing your margins and they're seeing contracts come through at the current rate, that's what you want, don't you? You want growing sales and growing margins. That's the holy grail. And they look like they've got it. But the whole sector is Galliford Try, I think. And, you can sort of say all of that sector that construction, nobody wanted a year or two ago, no one wanted to touch it because, margins were so small and they were always getting it for added costs and stuff like that, and they've all changed their business model, and it's inflation plus or whatever. And now, so great little stock, I think, and they're in 6-year high. I see. I mean, last week. So
and they're still trading at just over 8 times PE, and they've got little debt. So you're right, they're definitely cheap. And I think that even though the whole sector's gone up, it's still overall by institutions underowned because people are just scared, about what's happened in the past.
And these institutions are all the same, aren't they? Like a year or two ago, no one wanted to touch them, and then once they start to rise, and they watch one or two other institutions going, they're herd creatures, aren't they? They all want to join. They all want to have someone hold their hand, and once one starts, they all do it, and then once they all three start bigging it up, they're all bigging it up, and then. So you want to be ahead of the funds. It takes some time to buy positions as well. So they're in there. They're trying to build position. They ain't going to get a big position in Kier that quick. Not while they're doing buybacks as well. So
it's a very good analogy because they're a bit like buffaloes, aren't they? They all pile out and then they all pile in again. They sort of migrate in and out of sectors.
Broker forecasts are the same. When the market's high, brokers are adding higher and higher valuations, and then suddenly, once one broker says no, actually the emperor's got no clothes. And then suddenly they all say, "Oh yeah, he's naked," and they all reverse.
No, you're right. But if you're right, if you're a trader, you can actually, or you see that coming, then you can benefit from it. And
especially smaller guys, you haven't got to buy. Most guys are probably buying a few grand's worth or 10, 15, 50 grand's worth or whatever. It's no difficulty getting a position like that. These funds have got to buy £1 million worth, multi-million pounds worth of positions. It's going to take them weeks, months maybe to get the position they want, and you can just sit in there and get in ahead of them and just ride on their coattails. So,
no, you're right. Yeah, it's finding those targets where they're going to herd, where they're going to migrate to.
Next,
I know. Okay, we've got Philip. He's asking about in that same sector, Watkin Jones, which does purpose-built student accommodation and build to rent. Used to be an absolute darling. Now gone through a bit of a tough patch. I think they've got some cladding issues and building safety issues they need to pay for. How do you see this one? Again, it could be on the cusp of a good turnaround, but equally it could still be a bit challenged. What's your view?
Yeah. Well, they've had a big decline for a long while, and then they changed. They got a new CEO moved up from COO.
Yeah,
and,
Alex Peace.
Alex Peace, yeah, and Simon Jones is the new FD.
Yeah,
and they've changed the business model so that they go in and they actually buy the plot of land, get the development planning on it, and then they go out to companies like property funds and say, look, we've got this land, we can develop it. What do you want developed? We can develop it for you. You pay the cost of the developing it. We'll do the development, and at the end of it, we'll split the profits between us as well. So it's a very capital light business in that as soon as they've bought it and got the planning and they sell that off to somebody, then it's cash generative all the way. So their cash generation has been fantastic recently, and I think they're last time I looked about 85 million, almost a market cap in cash, but they have got some remedial problems which from the cladding, which is going to add up to about 30 or 40 million pounds of that cash is earmarked for that. Having said that, they've developed their own side of the business now. They've got Fresh and Refresh
Fresh and Refresh.
Yeah, they've got Fresh and Refresh, and I can never quite remember which one's which. They should have two totally different names so I can keep this part. But one does the all this cladding stuff as part of refurbishment of these buildings.
That must be Refresh.
Yeah, and now they're going out to other companies as well and doing it for them.
Yeah.
So they're making a little small business out of it as well on top. And these companies have come to them and said, you've made a cracking job of this one. We bought a few, how about doing this one as well? Or we've got a few more. So there's that to them. Interest rates, they said, is what will benefit the most once interest rates come down. These properties are far more attractive compared to buying into fixed interest for these funds. So that would help them a lot if interest rates come down. The one little bugbear is that the Labour government have set up a lot of new regulations about them with the cladding that they had and everything else. They've introduced some more regulations, hoops and hurdles that these companies have to jump through. And it's started to slow the sector down a bit. Right. And so I think they were a little bit more cautious on their forecasts at the last set of results and guided that, as if their earnings might slip back possibly into the next year.
They're lumpy orders, aren't they?
It's the problem. They've got big lumpy orders. So, you have a fantastic couple of months and then things are quiet. And so you can look on the quiet few months and spook yourself and think, they get no business. But that's just the natural flow of things. So, but I think it's one of these companies that is trading cheaply at the moment. If they start doing their 4p EP earnings a year and they carry on generating the sort of cash they're generating, then I think they're a cheap business, and it's one of those ones you can see. If Alex Peace he knows what he's doing, then it's a new board there. That's one of the things you definitely need. A bit of change, catalyst to get things going. Simon Jones, the FD, seems to be a real shrewd guy, so he's changed the cash situation there. Great. So I don't think it's any at risk. It's just how fast are they going to grow and how soon are the orders going to come through and how lumpy will they be.
Yeah, good.
It looks cheap here to me. Looks cheap.
Good. Okay, we'll switch sectors. We've got Stephen Cahill. He's asking about Liontrust, another one which is extremely cheap. Fund manager. I was just looking at the numbers, and I can't believe it. I'm sure they're going to cut it, but 19% dividend yield apparently, and a 7.5% PE with a shed load of cash on the balance sheet. But obviously, they've been losing assets under management like at a fair clip over the last 3 or 4 years. They're an active retail fund manager, i.e. they do actives rather than passives, which hasn't been the place to be, and I think they've lacked a bit of differentiation. But what are you seeing in this one, Richard?
Well, the directors bought a load of shares, just I think towards the beginning of the year, £250,000 worth and so, and there was another £100,000 worth, and and they confidently said, they can continue to pay that dividend until October. They're confident at least to beyond October this year. And you sort of think the market feels like it's turning now. And if they start seeing inflows rather than outflows, and they can maintain that dividend, you sort of in your mind you think what is it? I don't know what the yield is now, but it's something like
it's 19%.
19% now. You sort of it doesn't seem like a company. These dividends. What ends up happening is they come out and they say, we're going to halve the dividend and stuff like that, and you sort of think, oh, that's better. But when they do that, it would still be a good yield. 10% would be a good yield if they halve the dividend. And will it do it? Will they maintain? If they maintain a dividend, it'll be fantastic because people will be piling in there like no one's business. If the stock market goes up, you're getting capital gain and you're getting a 20% yield, which will rapidly decline as the share price rockets, I would think. That's if they maintain that dividend. It all is about that. It's about, will they maintain that dividend, and if they cut it, how much will they cut it by? And will they start to see inflows soon? And I've bought on the basis that the directors put a lot of money in it and they seem confident. They could be completely stupid, and in which case I'll be completely stupid as well. But it's one of those. I haven't got a massive amount of them in there, but it's one of those that you just think to yourself, the chart looks like it's making a bomb, and I want to be there, just because I've seen it, and I don't want to sit there and say I saw that and I let it go.
I did look at their last trading updates or their last results, and I think most of their funds actually over the last 5 years have been pretty poor performers, actually. So I think that's what they really need to turn to, then start attracting fresh money. And the brand is damaged but not broken, in my view. I mean, Liontrust is well respected still in the industry, but it needs to change its performance. And I think if you've got a fresh management who can actually deliver the returns in their active, I mean, it's a stock picker's market. You've demonstrated that if you're an active stock picker, you can do well over the long term, short term. And that's what these guys, they need you, Richard, basically.
No, I wouldn't want to be doing them sort of sizes, trying to get in our great big positions that these people have. Mine are tough enough.
Okay, we've got AL8 basically asking about, it's a new company listed. It's very small. It's called Earnz. I don't know if you've ever looked at it. It basically does servicing of residential boilers and heating and stuff like that for housing associations. I think it's a bit like Mears. He says the CEO is a new guy called Bob Holt, who actually set up Mears.
I know Bob Holt. He did set up Mears.
And I think they've just done a placing, and they've just raised a bit of money to buy a business in this particular sector. So it's going to be a buy and build strategy, still fairly early. Market cap's only about 4 or 5 million. I don't know if you've ever had a look at this. I'm guessing you probably haven't. It seemed too small for us to, I think.
What's the ticker again, Paul?
The ticker is Earn. It's EARN. I'll put the chart up in a moment, just when I can find it. I've never looked at it myself, but I think you're probably backing Bob, who I do know, as I say, it did very well, didn't he? Out of Mears.
Volume 60.2%.
Got it. Yeah. So they've been around for about 3 years now, 3 or 4 years. No, I've never looked at them. The chart's fallen right way down, but there's a big volume spike just recently. I see that. I haven't looked at them, but Bob Holt, I think he's a bit of a love-hate figure. I think there's a couple of businesses he's been in. Mears, he did extremely well, but there's been another couple of companies he's around. There's his son involved as well now these days, I think, mate. Possibly. But that's probably what would drive it. If Bob Holt's there, he's got a bit of a following. He's getting on a bit now, though. I would have thought so.
Yeah, I think AL, you're betting on Bob basically because it's still early days. And if you can repeat his Mears,
4 pence when I first looked at Mears, I bought them about 9 pence. I think I sold them about one of my great ones. I think I made about 7-fold on them and sold them, but they went up even more. I could have had so many times more from those. So that Mears was a cracking buy when Bob Holt took over. But there's a couple of other things he's been in, I think, which perhaps haven't done so well. So it's whether you love him or hate him, Bob Holt.
I think he was the chairman of Totally, and I think also he was in chairman of Revolution Beauty, I think, as well.
That's where he was, Revolution Beauty, I think.
Okay. We've got a question from Invest the Rest with Beth. So Beth, she's asking about Future Group. She says the PE is 5 with strong cash generation. Future, for everybody, is a price comparison website that owns, I can't remember which one it was, Go Compare, I think it is, and has then got a lot of sort of like specialist online real estate like Marie Claire and some financial ones out in the States and some tech ones as well. gone through the real mill recently. How do you see this one at all? Have you ever had a look at it?
Well, look at our tin bag there. I think I had it.
Oh, did you? Oh, God, sorry. Okay.
I bought them at 10 pence, and then they had a consolidation to £1.
Yeah.
So, and then I think I sold them at about 18 quid a couple of years later.
Oh, well done.
Zilla.
Yeah, Zilla. That's it.
Zilla Bing Thorn, and everyone calls it Godzilla. And she did so well there, and she's gone across the Trustpilot, which is sort of like a similar business in a way that they're not publishing, but they're doing consumer sentiment really. I think the problem for them is going to be with AI. I think AI is probably going to affect them a lot.
Yeah,
and all these companies, and do they use it and put it to good use and gain from it, or do they find the competition from it too difficult? I think a lot of these reviews and stuff like that, because that's what Future does. They do these like camera reviews, and then you see the camera, you get the review, and there's the click through, and they make their money. Will AI do a better review or a cheaper review and everything from all? So like Reach and all these ones that are trying to get click-throughs, it may become harder, but I think that's probably what the market's looking at now. In all honesty, I thought when they got to like a P of 8, when they went up to 18 quid after I'd sold them, when I sold, I just thought that was easy to tie. They went on to about 28 quid, I think, before they came back down again. So I sold him too soon on that, but that was a fantastic ride at the time. Yeah. And and that was it looked like it was going to be a really good company, but then Zilla Bing Thorn decided she wanted to go somewhere else, and it looked like she'd enjoyed. She knew when to get in and get out, and so I think she had something to do with Auto Trader as well, and now this. So I don't know what the new management's like. I've not looked at them since, but I keep looking at the shares, and I can't be attracted back into it. I think, sometimes don't go out with old girlfriends. That's an old. It's never the same the second time.
Or boyfriends. There's not.
Old boyfriends.
But it comes. I think it comes back to your herd mentality. But when it hit over 30 quid 4 or 5 years ago, everybody was locked down in the pandemic and thinking online digital reviews was just going to be continued forever and do really well. So the valuation was a lot higher. Now that AI has been released, which was sort of the back end of 22 with ChatGPT, the big problem you get, in my view, is not only the reviews, but also the removal of a lot of the blue links on Google. And if you've got a lot of your traffic, which is basically being generated from search, then you're gonna have a moment in the not in the sun, in the dark, I think, and you've got to get through that. And if the management team has got a strategy to avoid getting hit by the loss of traffic from the likes of Google, then they should do well. But that's going to be a major issue for them. No doubt about it.
I think there's better places now. I think there's, don't try that. It's never really good to hope for them to relive a great time again. The original concerts, ELO concerts were always the best. And if you watch one now, it's probably not going to be as good as it was before with Jeff Lynne and whatever. So.
Good point. Okay, let's move to another one.
I threw a Brummie band in there for you.
Yeah, I know. Yeah, no, I liked ELO. They were good. Okay, let's move to another sector. We've got a potential turnaround. Is Carclo. I know we talked about it last time. Just sort of a precision components on a contract manufacturer for lots of OEMs, sells them into life sciences and defence and all these kind of. And it seems the shares have done pretty well actually over the last year. So they don't owe you anything, I don't think, Richard.
No, they've got a nice bowl on that chart as well as a cracking. There's two bowls, a long term, long-term and short term. They've made a good. They got the new CEO in there, Frank Dorenbush, of a couple of years ago, and he's got rid of one of the factories out in the US, the Tucson, and it's all manufactured out in Philadelphia, I think it is Philadelphia. Yeah. So that's cut a massive amount of costs, but a lot of those cost savings won't kick in till this year. So, and they've recently said that they've reduced their debt from, I think it was 29 million to 19 million. So they reduced their debt by a third. They said earnings were ahead of forecast. And this is one of those companies, what were they? They were 180 pence I think about 5 or 6 years ago, and they were doing 12p earnings a share.
Yeah.
And there's been little to no share dilution at all in that time. The only thing they've got is a pension deficit, which is quite large, about 40 million now, I think it is. But that has come down from about 60 million recently.
Yeah.
And, you know, they're actually going to start producing their own products. They're designing their own products now because he sort of understands that if you've got your own products, you've got margins.
Yes.
So they're just making stuff for everybody else. So they're going to have their own branded products. And once they start doing that as well, it could be really seriously interesting. So the CTP division does all the intro drug stuff, you know, like the plastics, the COVID testers and things like that we're doing. And then they've got a specialist division for aerospace and optics where they can create a lot greater margins, I think, and do a lot of their own products. So they're just currently in about a 3.5 year high, I think it is. And results are out, I think, in the end of June. It could be the end of June. They used to be the end of June, the results. And last couple of years, it's been July. But I think with Frank in there now, you know, and he's got when companies get their act together, the results date starts to get earlier when results are better, don't they? And when companies are not doing bad, the results date tends to go back and slip, and they don't really want to get it out. Yeah. So it's nice to see earlier results dates come out as well if you get it. So I think, you know, there's the potential there to get back to 12 pence EPS quite easily, and because there's been no dilution, and their debt is what it was back then when they were doing 12 pence EPS as well. It's only the pension deficit that's the little kicker there, but as they get bigger, that pension deficit becomes a smaller issue. So I think it's a really possibly great turnaround company, but we'll see. You know, once
they need to raise any more money at all to basically, you know, continue to invest in their product line, because presumably their debt or their cash generation is going to be used to solve the pension deficit.
They just refinanced just
right,
just what 3 or 4 months ago, two or 3 months ago, and so that secures their funding for the next few years. So whether they do later on, just, you know, have a small funding, but I don't think they want to do a funding it down here with the share price this low. I think you can get the share price a lot lower before they maybe have a little placing or something like that. But you know, I think if they did that, the market would like it and start seeing this back to where it was. It was a great company before they bought Warpaint, and this is ancient history, but about 20 odd years ago, and that was a disaster. They bought it and for a high price and sold it for a tiddly price, I think. So
yeah, that was the car lamps, I think, business.
Yeah. But I think Frank Dornbush really seems to be, you know, the previous guy, Nick Saunders was the previous CEO, and he came in. I think he was the right hand man to John Moulton at Alchemy Partners. Yeah, and he seemed like he was a real deal. He come from the right place for turnarounds, but he struggled, and he actually brought in Frank Dornbush and Hutchinson as non-executive directors, and now they've taken over as finance director. Hutchinson's just gone down. They've brought in Takayas from ZAR. So he's got a good team there. The chairman, him, and the finance director, and I think Frank Dornbush is the real deal, really. So we'll see. But everything he's done this time has been good, you know, compared to what Sanders talked the talk and overpromised. Well, one of the actual things he said, Dornbush, is this company needs to stop overpromising and under-delivering. He said it's done it for too long. So having said that, I really hope that, you know, now he's going to demonstrate that now, and he's under-promising and over-delivering in scale, hopefully. So.
Good. Okay, let's move sectors. We've got Gordon. He's asking about Creightons, which is basically a personal products, cosmetics sort of contract manufacturer. And it's quite interesting because obviously you talked about the Carclo moving up into its own products, but Creightons seems to be selling us still a lot of third-party supermarket brands and sort of making for other third parties, other OEMs. It does its own stuff as well. How do you see this one?
They do white label, they do contract manufacturing, and they do their own product. And this company was going great, and they had a guy in there Bernard Johnson, who was the CEO, and he had a mad moment and started, he was actually getting overconfident and telling people that they were going to get to these huge sales levels, and we were going to acquire because it got cash. It was like a swan song. He was getting on a bit. Him and his McElvoy, the chairman, and they went out and bought this Emma Hardy for a ridiculous valuation and spent a fortune on it. And they've had to write that all down straight away. And another company they bought as well weren't so bad, the acquisition. Anyway, long and short of it was he had to walk after that because it was just it was a disaster. The girl that's been there all the time, she came from Potter and Moore, I think they were called, down in Devon.
Philippa Clark.
Yeah, that's it, Pippa Clark. She's all along. She really has been like the front face the public from the. I mean, when they do the meetings, she'll be there at the front, telling all the details. You can see she's all over the business. So they've closed the factory. They've ended their shifts, their night shifts. So they've reduced the wage bill, and they've taken production lines and broken them apart and made their own new production lines out of old production lines to keep the cost down. And sure enough, they reinstated the divvy last year, which was, everyone questioned and said, really, you sure you're not doing that too early? But incredibly confident, and they came out with good H1 earnings. And I think this year they'll possibly did 1.6 pence the earnings they did in the first half. I wouldn't be surprised if they do a good 2p in the second half, which is their better half. We'll have another dividend again this year, and I think she's running it really well, the business. And cosmetics industry, Warpaint has been a darling of the cosmetics industry. I think Revolution Beauty has been an absolute nightmare, and Creightons sits somewhere in between, where they're actually not trying to be the big I am brand. They do a few small brands of their own. They've got Emma Hardy, which could be something eventually, and they've got a few other. Feather and Down, I think, is another one of theirs, and so they make some good money on their own brands, and they sell them direct out through either Amazon, and they've got Tesco's and a few other big supermarkets. They sell their own brands through, but then they make stuff for those brands, those companies as well under their own brand name. And I think that they look like they got overvalued on Emma Hardy. They took a real beating and went down too cheap on the punishment for Emma Hardy going wrong. But now with Pippa in charge, I think you're probably going to see a decent turnaround here. Directors have been buying recently, and so that's nice to see. And the CFO got promoted to the board recently, so they're obviously happy with what the CFO is doing there. He seems to be a good guy who's done quite well. So all the bits are there. It's just a matter of waiting for the trading statement, which will probably be in the next month or two, or probably next month. I think it is. But I think it's another one of those great little small cap recovery plays. No dilution, and you just wait for the earnings to come back, and everyone suddenly get excited again. And I know anybody bought them, he likes them, so that's always a good recommend.
Yeah. I mean, with that business model of making contract manufacturing for us, your supermarkets, another third, but the sort of role model has been the turnaround is at McBride's, which does it in sort of like detergents and a bit in sort of personal products and stuff like that. Okay, you mentioned
similar to McBride in many ways, just that one's makeup and the others like home cleaning stuff and that.
Yeah, good. We got just on one we mentioned. We got Carclo, who's asking about Warpaint, that did actually cosmetics brand that did actually come out with a revenue warning today, reduced like-for-like sales in Q2. It saw particular softness, I think, in the US. Profits it's managed to hold because of margin expansion. But just any quick thoughts on that one? He says the sparkle seems to have gone out of it a bit.
Yeah, I haven't got as many as I did have. I did have quite a lot of these, but I haven't got many really. What they said today, the US, the sales in the US wasn't as strong as they'd hoped due to the tariff, and that's where their growth was going to come from. And then they said earnings will be weighted to H2. And nobody likes hearing that. They always, when you hear their earnings will be even more weighted to H2, everyone sort of says, "Are they too scared to tell you that they're not going to make their numbers?" Today they're off a bit this morning. I saw they come off 20, 25 pence or something this morning on the news. I did think people wouldn't be overexcited by what they said. So I think bizarrely the CEO is a shrewd guy. Where they've got to so far has been good. Maybe the rating is probably up with it at the moment, and you need to see a bit more growth. Yeah. For the rating to be able to re-rate any further than this.
Yeah, it's about 15 times PE.
Yeah, it's come down from where it was because it was trading up around nearly the 30s. So it's got a better rating now.
So I guess the question is do you hold this one if you own it, or do you basically decide actually this is the first of perhaps a few tougher trading updates?
I think probably reduce. I think maybe. Luckily, I've already reduced. So I'm down to a volume that won't matter too much. Yeah. So I can say that. But I think probably if I was holding a lot this morning, I would have probably gradually reduced through the day to get down to. Yeah. Just because it might have made me a little bit insecure to hold too many. But I like the company and I think they're good. And I think if they can get the US growth and the tariffs don't hurt them too much, and they've said their margins are going to be higher actually. So, in all fairness, that's a good sign as well. Yeah. And you may be sort of being too gloomy here. Yeah. But I think it's still a decent hold at the moment.
Okay, we've got a couple of broader questions. We've got Terry Quigley. He's asking about how you create your stock watch list. And then on top of that, we've got Edward Hardy. He's asking about whether you use level 2 at all for you're doing the bowls and when you get in and out. So first of all, how do you create your stock watch list? What's the sort of the criteria on it?
Right, I've got I'm after recovery plays mostly. So the things I want to see is a new directors, new board or board changes, or some catalyst actually getting the thing to change. I want to see a chart that looks like it's bottomed or bottoming, and then I'm looking for companies to sound a little bit more optimistic. They're less pessimistic. They haven't got to sound optimistic. Yeah, just a little less pessimistic. Yeah, and that's the point at which I think probably I want to be a buyer, but I'll track companies. As soon as I see a board change, I'll probably make up a stock list of companies that have got board changes going on and that have been bombed out and they're on their way down and they've got board changes. And then I'll keep watching that watch list and waiting to see the director buying come in and see the chart starting to bottom and then see them sounding less pessimistic. And then once you get all those, you're sort of in that point where the chart's going to probably turn up and you've got the catalyst for a recovery play. Yeah. So, and then once I've seen those, some of those will move up onto me buy list and at that point and become part of the portfolio. So that's the way I do that. And it's a matter of watching the RNSs, watching out for companies that have got changes going. And even companies that you wouldn't touch with a barge pole. If they get a directed board change, that a new board can change the complete direction. It can become a different company. Yeah. So that's what you need. Bad directors don't become good directors. So you want new directors in there that hopefully have done it before, got a good track record, and so that's how I'll make my list up. And
do you use level 2? Also, do you use level 2, which was Edward's?
Yeah, I've got level 2. I don't find it awfully useful, to be honest, these days. It used to be great. I had level 2 when it was first available to private investors, probably 25 years ago. Pro quotes, came out, and I had level 2 on that, and just understand. And it was fantastic. I could watch level 2, see it starting to move, go and buy some shares with Lloyd's, and then just wait. And then I could sell it in the afternoon because I could already see the shares starting to move. But today, a lot of the sets and level 2 doesn't give you a genuine guide to what's going on because there's all these, what they call them, icebergs and snake in the grass things that these market makers get up to. So what is actually going on. So it's good to see. It's good to watch the trades going through live, and you can see, now and then you see a lump of big trades go through a price above market, and that sort of says to me, "Oh, there's something going on there. Pay a bit of attention." So,
okay,
I'm not overly dependent on level 2, but it's handy to have, and it comes with share pad, so have it.
Yeah, we got a question that Mr. and Mrs. Greenspouts, they're asking about one risky stock called Wood Group, and the question is, do you think the institutions would back a possible offer for 35p? She says it's been a complete mess in terms of, I think it does contracting for oil and gas, and the balance sheet's been totally hit. And they had an offer, didn't they, about 2 years ago at about 160?
Dragged on, and
Sadara, is that Sadara is the one who was interested?
I don't know. In actual fact, once it's got down to about 50p, I walked away and didn't want to look at it again. I looked at it a couple of times and got stung, and I just walked away. And in all honesty, when you're sitting there relying on a bid, I'd sooner find somewhere else, to be honest. If you struggle to get a bid at 35 pence all that time, why hasn't somebody else moved in and outbid them, or had a rattle after them again? And I just think, there's better when the market's moving elsewhere and you get one baggers in a few weeks. Why do I want to be in Wood hoping that there might be a bid to get there? I just, look around it and see, are you investing in the right place really for where you are? There's loads of opportunities out there. The last 3 years it was difficult because the AIM market was falling and the UK market, but over since January, there's loads of places where you can find stocks that are going ahead, and you can waste your time waiting forever for a bid. Waiting for a bid can be, it's like waiting for Godot. Yeah.
Okay. In that same vein, the same context, then, because there's the same issue, but not quite as risky, is Ben Sharman. He's asking about Capita, whether you've ever looked at that one recently. Basically, an outsourcer, largely to, I think it's 50% public services, does a lot of contact centers, and then the other 50% is into corporate. It's got some big contracts, actually. I think it did the electronic tagging, the data on it, not the actual tagging for prisoners, and it's got the congestion charge and IT systems. Sold off a few things. The shares have recovered a bit, but they're still long-term pretty much down. Anyway, I don't know if you've had a look at this one for Ben at all.
It's Richard Staveley you should be talking to, I think. Richard Staveley.
Yeah, he's the guy, isn't he? Yeah.
I did buy a few at one point because he was saying that there's some of the parts there.
Yeah.
So large that they could sell off a few bits, and they got a new CFO in there, and he did announce 1 or 2 deals were sold off. But the chart looks. Let me just have a look again because
here's the chart. It's all downhill basically.
Yeah.
And then if you want a nearer term, it's that one, which is it's basically tracked the rebound in small caps.
Yeah, there was that first little bowl back there at the beginning of 2025 where it looked like it was going to go and it didn't, and that gave way, and it's done it again and gave way. The trend just recently has been pretty interesting, but these big conglomerates are too difficult to get your head around and know just what these parts are worth. It could very well have something in there that's really worth a lot more than we all think, and they could sell it off at a decent valuation. The shares would go, but I get bored too quickly in stuff like this. It's all. I like to see stuff that I fully understand and it's all going on, and conglomerates. Great if you get someone really good who can go in there and break them all up and carpet bag them and everything else, but. I think I would places again, probably in all honesty.
Yeah, I would say to Ben, have a look at what AI's done, and they're definitely benefiting a bit because they're putting in agentic AI into their services, which I think they're lifting and shifting from the Salesforce software they're using. So they're going to help customers, and that should improve the quality of their business. But they don't own that. That's the problem. So it's all longer term. Do you actually, is AI going to benefit them? And the answer to that is yes, in terms of quality of services and reducing their cost base in call centers. But it could get to the stage whereby actually it replaces them and it reduces pricing because other people offer those services, and therefore you've got an infinite supply, even though you've got higher demand. So it's basically, to me, it's really your own call about whether it's a long term, and that's really what the market's saying. It's still a sort of wait, a show me story, I think.
Yeah, and all over the place as well. Sometimes I'll be season tickets at the Emirates, and I went there and Capita's doing the food at the Emirates and stuff like that. And the staffing, and I'm there. It's all over the place. Trying to have a guy manage a business that's got so much stuff in all different directions.
Yeah.
I struggle to be able to get my head around it. It might be a really good investment, but for me on my own, I need a team to sit there and go through it and come report back to me and tell me everything about it. I just don't have the time to do that when there's other opportunities that are far easier to get your head around.
Yeah. No, I'd agree. Okay, good. Let's go to one you have got your head around and been a really good winner of late, theWorks, which is basically a shop that sells affordable products on the high street. Shares have just taken off over the last 2 months. What's the story behind this one, and is it going to continue? Because the trend is definitely your friend at the moment.
Well, I'll tell you, this company I watched from when they first floated in about 2018, and that was, I've made money, I've lost money, I've done all sorts with it. It's been up and down, hot and cold. They got a new CEO in Gavin Peck, and I watched that. And then about 2 years ago, 18 months ago, Kelso took a stake. And a few people say, Kelso in there, they've bought a stake in there. And I sort of was interested. I thought, this could be good. But how fast will things actually happen? And I've just kept watching ever since and kept watching. Anyway, so they've had a bunch of directors go in there and buy stakes, and all big city guys. They've got a guy, Graham Coulthard, who he's bought 7.4%. He's a retired private equity partner and private investor. Hudson Management have bought 17%. There's a guy called Mike Burns who's bought 5.7%. Kelso's bought 6.4%. Yeah. And altogether, they've got 38. They've bought about 34% of the company. Yeah. And they've got in there, and Kelso walked in and said, we want a couple of places on the board. And I think the rest of these guys backed Kelso to go in there and do all this. And they were on the board for several months, and then they came out and said, I've got the quote here. It says, we joined the Works board on a temporary basis to provide additional guidance as the business underwent a period of change. Since then, significant progress has been made, namely transferring from the main market to AIM and strengthening the leadership team. We're content to step down now, knowing that the company is on the path to growth and with full confidence in the management team. Well, they put a new chairman in there, and he kept buying shares recently, 100,000 here, 100,000 there. He's bought 700,000 shares. And I kept watching, and I stuck it in my Substack about 4 weeks ago and said, watch out for the results, because I think these could be interesting. They came out and said the results are well ahead. They're going to do 9.5 million EBITDA this year, which is up 3.5 million on last year. Yeah. They've absorbed all the wage rises from the minimum wage rise, and they've said we're going to make even higher profits next year, despite a 6 million hit from national insurance. Yeah. And I sort of think, if you've got that much momentum behind you now, you're, to be able to absorb those hits and still grow your profits, you've got some momentum. So these guys went in and they've changed all they've got a completely new, different model for the business now, where they're concentrating on doing stuff for families to get your kids off the computer. And it's all games, crafting and books that are you can have games with your family at night on a Saturday night. So it's all the family playing a board game, or in the garden, the games playing in the garden, little
tennis or something like that.
Yeah, they throw the sticky balls on the targets and bubble machines and everything. Basically everything to get kids off the screen and doing decent stuff, fun stuff. They've said they're going to get EBITDA margins to 6% at least. They've said they're going to grow sales 100 million in the next 5 years at least, which would be on top of the current sales of 277 million at the moment, getting to 370. And they've got a market cap of 27 million. Yeah. So they're a tenth of sales. So you just get your margins up. You've got that much sales. Yeah. You just get your margins up. And
it's going to be possible to get your margins, because they've got 2% operating margins, and I would doubt they'd have huge pricing power. But can they get the margins up through better efficiencies? That's the idea.
Well, I think the website for one is they're called works.co.uk.
Yeah.
And the .co.uk has been a nonsense, because they only do 10% online. It doesn't seem to have grown at all in all that time.
Yeah.
And so the guys they've got in there One of them is one of the guys. I've got it here. He's Stephen Bellamy, the chairman. He comes from a finance and due diligence. Financial due diligence business.
Yeah,
that's what he's done all his life, financial due diligence. So he's a nice guy to have in there. They've got Simon Hathaway, who's a retail guy who set up Tesco's Subway thing in Seoul and a link with Samsung. And he runs, I think it's called the Marketing Society.
Yeah,
and there's a couple of other directors in there, and they've all got niches that are relevant to the works and being an online retailer as well as a retailer. And so they've said they're going to change the online website. They've done that, in fairness to them. When you go on there, it's really quick. And they compete with the likes of, well, the books they sell, they do it like with Amazon. I think the Clarkson's Diddley Squat book on there, the hardback, is £11 on Amazon. It's a £5 with the works. Right. And they do the paperbacks. Billy Connolly's one is, I think it's something like £7 on Amazon. It's about £3.50 on at the works. No, £6 on Amazon, £3.50 at the works, and you can get free books for £7.50 on Amazon. All decent books like that. So they're undercutting Amazon on books in a lot of it. A lot of the time. Other times it's a bit sort of, they're both nearly on a par.
Yeah. What's the brand? What's the brand values? I mean, is it basically like a treasure hunt? You go into the store and you find something that is really going to intrigue you, and you buy it. Is that what draws people in? It's a sort of like a treasure hunt type of stuff.
Well, I think the problem is it hasn't drawn people in. The people, right. I spoke to loads of people, and they say, "Oh, we've got works near us." I say, "You ever go in there?" No. Yeah. And that's the thing. People don't go in there. They look at the store and see it there, and they don't go in there. But they've said they're going to. What they're actually going to do is increase the brand fame, so brand awareness basically, and make people aware of not just what the brand. There's a brand called the Works, but what they actually do, and so.
And what do that? I mean, are they supposed their USP on the high street is it basically it's to attract? It's like a treasure hunt. Is that the whole idea?
It's basically three main sectors. There's toys and games for kids.
Yeah.
So it would be one of their targets. Books.
Yeah.
And crafting materials.
Right.
So I go in there because I'm a bit of an artist. People always said I'm a bit of an artist, to be honest. So
was that a compliment?
Yeah. So, but I go in there. I like a bit of painting. They sell canvases and brushes and stuff like that, all at a very good price.
Okay.
There'll be books that they do. The problem is I don't think they've ever used the store footprint very well. Funnily enough, the guy that floated these was Dean Hoyle, who's the chairman of Huddersfield Town. And he also started Card Factory, and so they're both similar type of businesses in a way. They're sort of targeting low cost, easy stuff to sort of sell. And Card Factory, when they changed the complete layouts of their stores because the stores were never laid out in a way that used the footprint well. Yeah. And I think Works have identified that as well. When you go in there, it's a bit of you sort of feel you're wandering around the place a bit. It's not big enough to be a maze, but there's not aisles. They're sort of like you're around here and you creep around this corner. You don't see stuff. You don't bother going there because it looks a bit of they need to get the stores laid out. So they're doing that and they're getting that out and they're going to increase the awareness of the brand and what they do. And in all honesty, they've done it because the profits have turned around this one and they're ever so confident. It won't surprise me if they reinstate a divvy soon. At least a token divvy anyway. Their cash was up from 1.6 million last year to 4 million, I think, this year.
That's right.
So that's going the right way, and the results are out. I think the 22nd of July, and I think with the right people in there, they've bought 38%. These big investors have bought 38%. They're not going to be selling into the market when they want to get out, are they? With 38% of the works, they must have a pre-planned exit strategy.
Yeah.
So they know what they're going to do with this, and it's going to be a trade sale of some sort at the end of it. They're going to have to get the business, get it really rocking and rolling, and then say to someone, "Look, this is an ideal bolt-on. It's up for sale." And someone like, or possibly Car Factory, maybe Car Factory might want to get involved in something else at that time, because they do a lot of little cheap goods as well as cars. But something like that, and what they've gone in, they've all bought around about the 35 pence level. The shares are 50p now, so they haven't made a fortune at the moment. They must be expecting the shares to go higher before they actually sell out quite a way higher, and they sound very confident. So will it be another, like over the last 7 years, Gavin Peck come in there and it's all been a disappointment, or will they get all the bells and whistles and it becomes another tie rack or body shop or something where everyone gets excited about it and you sell out at multiples higher? I don't know. I think there's possibility it's going to go quite a bit higher than it is. So I've got quite a big hold in this one.
Okay, good luck with that. Okay, another one in the same sort of vein, in terms of turnaround, been through some real sort of like troubled times, is Staffline, the recruiter, blue collars it recruits, largely in sort of factories and engineering. Its temp business is doing well at the moment. How do you see this one? The shares have done extremely well over the last 5 months, actually, and the fact they've almost tripled.
Followed them for ages, and they just kept going down and down and down.
Yeah.
In spite of Henry Spain, Henry Spain have bought a huge percentage. I think I can't remember what their percentage is.
Who are they? Are they private equity or
little investment managers? So
Right.
So it's just for almost one to one. People are not even that wealthy. You haven't got to be that wealthy to invest with them, but they've got a good following. Apparently, I think they've had a good investment history, and they went steaming in on these. And I kept looking, and in fairness to them, they've kept buying and they've kept their confidence, and they've kept buying more and more shares, and they got a new board in there. And finally, this week, a few weeks back, they announced a big contract win. It was going to transform their earnings. The forecasts have gone up, way up. I think they're probably guiding conservatively and not over promising this time, and they look pretty cheap to me still if all goes well. Like you say, they provide staff for when you get the Christmas rush and Tesco's needs 5,000 temporary staff. They've got those 5,000 temporary staff just like that, and they seem to have got some quite a good reputation for getting these staff for people at the right time. And I don't, they used to do a lot of fruit pickers and all that stuff. I think way back, real temporary cash, almost gang monster type stuff. But I think the business has changed, and well done Henry Spain for sticking with it, and buying a real big stake. And I've been waiting for the right point to buy in, and the contract win seemed to be the right point. So I bought back in recently. So on that contract news. So I weren't that smart so early. I was a tad late, but
okay. All right, well, we've been going for more than an hour. I asked all my experts at the end of the the interview what their favourite stock is for the next sort of 12 months. Maybe the one we've talked about, or another one you quite fancy just highlighting as an total idea for people to run the slider all over.
I think theWorks would be the most exciting one. I find. I think theWorks and Filtronic are both very exciting stuff that could do extremely well. An outsider might be Churchill China.
Oh, okay, yeah. That's basically they do ceramics, don't they, for the food service industry?
Restaurants and that. And these restaurants, when they have refits, they have to. It's all a big rush, isn't it? And if it's a chain comes in and they want all the China, they'll quite a bit of stock, Churchill China, so they can supply rapidly. They don't make their China in China; they make the China in Britain. So it's a British-based company, the potteries, and the shares have become quite bombed out recently. But the trading updates are pretty good, and they sound quite confident. One of the things is the price of energy, because all that, when you're making pottery, you've got all that energy cost, but the price of gas has come down about 20% over the last few months. So, and the way they were talking about having their energy costs controlled in one of their notes, and I sort of got the feeling that they sound like they're doing better than they're trying to say. And the last recent statement was, it was sort of like we're doing this, but there's that. But we're doing this, but there's that. And it was good, bad. But they ended the note on a very sort of like positive note. And I think this is one of those ones that's bombed out that much. And lately, there was some huge buying in there. So I don't know, probably what, like I say, one of these funds has come back from America or something like that and trying to build a stake in small caps. And, you know, Churchill China has been a real good long-term investment over time. I watched it originally when, do you remember John Harvey Jones, Troubleshooter, on BBC?
Oh, yes, I do. Yeah, Harvey Jones, yeah.
One of the first companies he went to was the Ropers, Churchill China. And they were in absolute disarray. You know, they weren't making new patterns, and he tore the company apart, and they didn't want to listen to him. And in the end, he was right. And nearly all the Ropers have sold out. I think there's one Roper left in there now. And they've got the company running like clockwork and finely tuned machine. But of course, we've had Ukraine and other bits that put energy prices up, which spooked everyone. I think they've got that one under control now. And I think that could be one that I'd say could surprise people.
Yeah, they made good margins actually, 10%. I was looking at it, and they traded about 11, just under 11 times PE, so they're still pretty cheap actually. Yeah.
So I bought a stake in those. I quite like that as a
6% dividend yield as well, which is
that was quite nice. The one coming in.
Yeah, brilliant. Okay, well, thanks very much, Richard, for all those insights and comments. Thanks everyone for your questions, and very much look forward in hearing how things progress in about 3 months' time. So thanks again, Richard.
Nice to see you, Paul.